Okay, Jurgis, take one. Hi. The first question that most business owners ask when they start talking about selling their company is, what is the value of my company? What do I expect to get for my company? This topic of valuation probably has hundreds of books written about it. People have made careers out of doing valuations. But my task today is to go through this in just a couple of minutes to give you an idea of how we think about valuation. So basically, we feel that valuation is a process that includes three basic tasks. First is doing the theoretical analysis of your company. Secondly is to do a deep dive of the drivers that make your company valuable. And the third one is to do a buyer segmentation of all of the possible buyers that might be interested in buying your company. So what is the first pillar about? The theoretical part. Every investment banker will tell you that there are three ways to value your company. The first is to do a comparative analysis of recent transactions. This means that we look at all of the transactions in the space that are similar to your company, and we try to find out what people are paying for them. Now, for this we use public databases, but luckily we have our own database, internal database at IMAP. We do between 200 and 300 transactions a year, so we have a pretty good idea of what the values of companies are. The second analysis is a stock market valuation. What we do here is compare your company to similar companies on the stock market, but this has its own problems because companies on the stock market are much bigger, they are better capitalized, they have better corporate governance, and we have to take a deep discount on those valuations to find out what the valuation is, to get the valuation closer to that for a mid-market company. And the third one is a DCF model. So we build up a very complicated model of your company and try to predict all of the cash flows going forward and discount them to the present to get the present value of the future cash flows. Now, the obvious problem here is that, especially for a mid-cap company, anything beyond the first couple of years is pure guesswork. And a lot of times it just includes a standard year-by-year percentage increase. But nonetheless, all of these methods develop a range of values for us. And this range of values from the highest to the lowest is what we think that the market says your company is worth. And one additional data point is the last one, owner expectations. Now, sometimes owner expectations will be too high, sometimes they will be too low, but nonetheless, they're an important factor for putting into our analysis. The second pillar here is the company. So basically, we do a deep dive on the value drivers of your company. And for this, we can use a classical SWOT analysis. So we have the strengths, the weaknesses, the opportunities, and the threats for your company. And we drive all of the market value drivers through this kind of analysis. And each company will have a different set of value drivers that are important for that company. But let's put some general categories. First, we have the market. Is your market big, or is it specialized? Is it growing? Is it being disrupted? Who are the competitors in the market? Do you have a leading position? What are the barriers to entry to your market? Then we have technology. Is your company up to date with hardware, software, and equipment? Do you value innovation, or are you just sweating the assets and letting them ride? Thirdly, the financials, very important. What is the return on capital for your company as compared to other companies in your sector? Are your revenues and margins increasing? Are they stable? Are they volatile from year to year? Do you have transparent accounts? Do you have an efficient capital structure? All of this will be very important. And finally, management. Are you an owner that runs your own company and now you want to sell it and retire? Well, that's not going to work because we need to replace you with somebody else, and that's going to take time and money, and that will decrease your valuation. But if you have looked ahead and put management in place, that will be a big plus. And there are many other factors here that we haven't mentioned. And finally, we take a look at all of the universe of buyers. So there are different kinds of buyers. There are strategic buyers, also known as trade buyers. There are financial buyers, which are private equity, family offices, and each of these can have strategics that they've invested in, which are the more likely candidates for buying your company. And each of these buyers, many buyers, will have their own motivation for buying your company, and each motivation has its own value. So let's say that the company is interested in you because you have something that they don't have. And let's call that synergies. Or maybe they are a part of a private equity group and they want to do a market consolidation. That has its own value. Let's say the company is interested in you for capacity. They're running out of capacity. You're an efficient producer. Maybe you're in a low-cost country, so they want to buy this capacity to be able to expand their market. Or maybe a company just simply wants to buy you for the cash flow to add to their company, to add to their valuation. So let's put this on a supply-demand curve. This x-axis is the price that each of these companies are willing to pay for your company. And here's our range of values that we've predicted from the first step. And we can see that each of these companies and each of these strategies will produce a different valuation. Some of them will be above our predicted range, some of them will be inside of our predicted range, and some might be below our predicted range. But unless we know these motivations of the different buyers, we will lump them all into one and expect some kind of average valuation. So that's it. We have a valuation based on three pillars: the theoretical, the company, and the buyers. And if we know all of these ahead of time, we can use this in our negotiations to get you, the business owner, the best deal for your company. Thanks for watching. If you're interested to learn more about M&A, check out the other videos on our site.